Welcome. Today, we're going to build a new way of understanding risk. We'll start with its deepest philosophical roots and go all the way up to how it shows up in our complex financial markets today. We're going to assemble, piece by piece, an entire architecture for how we think about the unknown.
So let's kick things off with a paradox, one that seems to make no sense at all, but actually tells us something fundamental about how we deal with chance. One of these actions is pure risk-seeking. The other is deep risk aversion. So how can the very same person do both? To figure that out, we have to start at the very beginning, at the foundation.
And that foundation? It was laid by the economist Frank Knight. He argued that before we can even begin to manage risk, we have to understand that there are two totally different kinds of not knowing. One we can measure, and the other, well, the other we just have to live with.
What Knight did was pretty brilliant. He split the world in two. Over on the left, you've got risk. Think of it like a casino. The odds are known. You can measure it, you can put a price on it, and because of that, you can insure against it. But on the right, you have true uncertainty. This is uncharted territory, the world of the entrepreneur, facing situations so new you can't even list all the things that might happen, let alone guess the odds. And here's the kicker. Knight's big insight was that real profit doesn't come from taking calculated risks. It comes from using human judgment when you're facing the genuinely unknowable.
And you know, this isn't just some abstract idea. It has this really deep ethical side to it. I mean, is it fair for a company to force the risk of pollution on a town nearby? Philosophers would say that for a risk like that to be just, the people who have to bear it need to be compensated somehow. And that core idea, getting paid to take on a risk you can't just walk away from, that's a key thread. We're going to see it pop up again, woven right into the heart of modern finance.
Okay, so we've got this nice, clean, philosophical world. But what happens when these neat ideas slam into the messy, complicated reality of the human mind? Because while economists were busy building models of a perfectly rational person, psychologists were discovering that, well, that's just not how we work. Not at all.
And this table, it lays out that clash perfectly. On the left, you have classic economics, expected utility theory. It assumes we make choices based on our total wealth at the end of the day. But then on the right, you have prospect theory. And this isn't about how we should act, it's about what we actually do. We think in terms of gains and losses from where we're standing right now. Now just look at that value shape row. We're cautious when it comes to protecting what we've gained, but we turn into total gamblers when we're trying to avoid a sure loss. And that one little shift in perspective, it changes everything.
And maybe the most powerful idea to come out of prospect theory is this thing called loss aversion. The data is pretty clear on this. The pain you feel from losing $100 is about twice as strong as the pleasure you get from gaining that same $100. It's a simple emotional imbalance, and it explains so much of our weird financial behavior, like why we'll hold on to a losing stock forever, just hoping it'll get back to what we paid for it.
So this brings us full circle, right back to that paradox we started with. If you look at the raw numbers, both of these are technically bad bets. They have a negative expected value. So why on earth do we make them? Prospect theory holds the key. And here's the thing. The whole thing hinges on the fact that our brains are just not rational probability calculators. We give huge psychological weight to tiny chances of massive outcomes. We look at that tiny chance of winning the lottery, and our brain blows it way out of proportion, making us risk seekers. And then, at the exact same time, we look at the tiny chance of our house burning down, and we blow that up too, making us deeply risk-averse. The very same mental quirk is driving both decisions.
Okay, so we've seen how our own brains can be a bit flawed. But now let's turn to the incredible set of tools we invented to try and overcome those flaws. This is the story of how we tried to replace the whims of fate with the certainty of math.
And the crazy thing is, it all starts with a couple of mathematicians, Pascal and Fermat, just trying to figure out how to fairly split the pot in a card game that ended early. That simple question gave birth to probability theory. A few decades later, Bernoulli's law of large numbers proves that if you have enough data, even randomness starts to look predictable. And then you get Laplace, who takes that insight and applies it to all of society, laying the mathematical groundwork for the entire modern insurance industry.
And this right here is the magic trick. It's the secret sauce that makes our entire modern financial world even possible. An insurance company has absolutely no idea if your house is going to burn down. That's pure individual uncertainty. But thanks to the law of large numbers, they can predict with amazing accuracy how many houses will burn down out of a group of 1 million. They take all that individual chaos and, through aggregation, they turn it into a predictable, manageable risk for the whole group. All right, now we get to the main event. This is the arena where these two giant forces, our perfectly rational math models and our very irrational human psychology, slam into each other with billions of dollars on the line, the modern financial market.
So, modern finance theory, especially a model called CAPM, tells us we need to think about risk in two different buckets. Unsystematic risk is specific to a single company, like, say, a new product totally flops. You can get rid of that risk for free just by diversifying. But systematic risk? That affects everybody. It's the risk of the whole economy taking a nosedive. You can't diversify that away. And hey, remember that whole ethical thing we talked about? Getting paid for a risk that's forced on you? Well, that's exactly what the market's risk premium is. It's the extra return investors demand for having to bear that unavoidable, systematic risk.
Now, the absolute peak of this whole rational approach has to be the Black-Scholes model. It was this beautiful Nobel Prize-winning formula that for the first time ever gave us a rational price for financial insurance, what we call options. For a moment there, it really felt like we had finally conquered the chaos of the market with pure, beautiful math.
But like any perfect model trying to describe our messy world, it had to make some big assumptions to work. And to make all that elegant math possible, Black-Scholes had to assume that the riskiness of an asset, its volatility, is stable and predictable over time. Because without that assumption of stability, the whole beautiful formula just kind of falls apart. And of course, you can probably guess what's coming. When we actually look at the data from real markets, it turns out that's just not true at all. Volatility isn't some calm, steady number. It's a stormy sea, placid one minute and a full-blown hurricane the next. This is where you start to see the ghost in the machine.
What the data actually shows us is this thing called a volatility smile. Now, if the Black-Scholes model were 100% correct, this graph would just be a flat line. But it's not. What that U-shape, that smile, is telling us is that real live traders are consistently paying way more for insurance against extreme events, like a huge market crash or a massive speculative bubble, than the rational model says they should.
So the volatility smile, it's not just some data quirk. It's the physical footprint of our collective psychology, priced right into the market for everyone to see. It is, quite literally, the price of fear. It's the market showing its deep-seated loss aversion and its habit of overweighting the tiny chance of a total disaster. It's basically prospect theory staring you right in the face from a trading screen. Okay, so we've been through the philosophy, the psychology, the math, the market reality. So how do we weave all these threads together? How do we build a complete, sturdy architecture for actually dealing with uncertainty? Look, true mastery here isn't about finding some single perfect model. It's about building a strategy in layers. First, we have to accept our philosophical limits and just admit that some things are genuinely unknowable, just like Knight told us. Second, we have to integrate our own psychological reality and account for the biases that prospect theory shows us we all have. Then, with that knowledge, we can deploy our powerful mathematical tools. And finally, on top of all that, we build social systems to handle the big, collective risks that impact all of us. And that last piece of the puzzle, building social systems, it brings together two massive structures in our world: social safety nets and financial markets. They might look like they're worlds apart, but really, they're two sides of the same coin. When you get right down to it, they're both society's collective attempt to manage those big, systematic, unavoidable risks we all have to face, which fulfills that deep ethical need for compensation we talked about way back at the beginning.
And that right there is the grand synthesis. The quote here just nails it. The whole architecture is built with mathematical tools, but it's fundamentally shaped by our human minds. Every single system we've designed to manage the future, from a simple car insurance policy to the most complex financial derivative, is a direct reflection of us. It's a rational structure, but it's warped by our very irrational fears and hopes.
And so, all of this leaves us with one last, really big question. We've seen that things like fear and hope are literally priced into our markets. So if that's true, can our models ever really be detached from our feelings? And what does that mean for the stability of a system that, at the end of the day, isn't built on solid ground, but on the shifting sands of human emotion?